Retail sales declining by 1.1% in the month of December, marking the largest monthly drop in all of 2022 and perhaps flashing another sign that the consumer is slowing down spending. Here to discuss is Barclays consumer discretionary analyst Adrienne. Nice to see you. So let's talk about those retail sales. What do they portend for the entire retail sector as we move into 23?
That the consumer is getting less healthy. In 2022, I think what we really saw was the sub $70,000 household category, particularly in the $50,000 household income category, really pull back on spend. If you think about it, in that household segment, about 75 to 80% of their budget is spent on essentials, right? Things to just live. So not a lot of discretionary spend. What we saw during holiday is this income bracket, what we call wallet creep, kind of creeping up to 100, 125, the $150,000 household income, the top echelon of the U.S. economy. They're starting to pull back on a pretty significant basis, and they're the ones that have discretionary spending power. So it does not bode well for 2023.
Yeah, apologies for jumping in there. How much weaker then do you think this landscape could potentially get over the next several months?
So tough question. But what I will say is, let's put it into perspective. Half of the household incomes in the U.S. are $70,000 and below. And we talked about those already having pulled back on spending. The other half of them, 50%, are $70,000 and above. And they represent 65% of consumption in the U.S. So if we do see this, if we're correct and we do see this wallet creep and the indications of a sloppy holiday, right, manifesting into kind of spring, selling activity. And by the way, there are no more promotions. You're going to see the promotions dry up. And that was a huge catalyst for people to convert and to spend. So if there's pent-up demand and you see people at the higher income brackets who have the wherewithal to spend, as you just had the Microsoft layoffs, we hear about corporate level layoffs, white collar layoffs, almost on a daily basis now. And I think that negative mental impact, we saw this in the 2008 recession. It wasn't about those who could spend. They just stopped spending because you see to your left and to your right that there's, layoffs going on. And that causes kind of the mentality and the psyche of the consumer to worsen.
Yeah, one of the many things people have cut back on spending, furniture in this retail sales, and that has to do with Restoration Hardware, a stock you cover. Brian Sazi and Julie Hyman spoke to their CEO this morning in Davos. Here's what she had to say regarding the cycle between home buying and remodeling your home. Listen.
There's people who are still really in process of doing these projects, whether it's a kitchen or a bath remodel. And so usually the cycle goes, you buy a home, you do some remodel, and then you buy the furnishings that go with. And the minute you take everything out of a kitchen or out of a closet or out of a room to redo it and put it back in, you realize that you might need something to be replaced.
Said RH, I meant Williams-Sonoma. We will get to RH shortly. But that was an interesting revelation as we look at how these cycles impact one another. You downgraded Williams-Sonoma. What has surprised you as that stock continues to perform thus far this year?
Yes, it does surprise us. What I would say is we have a case in retail of what we call the rising laggards. Right. So remember, Williams-Sonoma was down about 32% last year. RH was down 50%. Williams-Sonoma is now up 9% year to date, and RH is up about 16%. There are even further laggards like Peloton and Stitch Fix that are up meaningfully more than that. So I think what we're seeing here is in the absence of information, right? And the next data point of information is going to be the 2023 guidance for these retailers in February, March, and April. And I think in the absence of that, people are trying to play this beta trade. Like, what if things are actually better? What if freight is actually net positive to the margins? The reason that we downgraded the home furnishing space is what Laura Alber was saying, and huge props to Williams-Sonoma for making it through this entire period of time with such strong margins. But the fact of the matter is, last third quarter was their first demand comp that was slightly negative. Right, their actual comp recognized revenue was up 7%. And through this entirety of the pandemic, this is their first, but for 1Q20, this is their first kind of slight break. And there is a lag period between the time that you see all these macro factors, slowing home sales, all those different macro factors that impact the home sales, there's about a 6 to 9 month lag. And so that demand comp is really what we keyed in on.
And Adrienne, I know you were saying promotions you expect to start drying up. What about inventory levels? I guess more so, what does that tell us about inventory levels? Are they expected to significantly improve? And how do you expect executives to manage those inventory levels following what's happened over the last 2 years?
That's a great question. And for all of the other apparel categories, the discretionary categories, we are seeing that the third quarter was that inflection in inventory. Inventory started to grow slower. The only two retailers that we follow that did not have that phenomenon happen, their inventory spread, right, sales dollar growth relative to inventory dollar growth, were Williams-Sonoma and RH, in large part because their sales slowed, right? So sales slows immediately, and you kind of slow down your inventory over the course of 6 months. So that's really for the rest of retail. We think that they're going to be starting in a very, apparel, they're going to start in a very clean inventory position in 2023. But it seems to be at the margin getting worse for the home furnishings guys due to sales slowing, right?
Indeed. Adrienne Yee, great perspective there. Thanks so much. Appreciate that.